It's been a minute since we've talked about financial independence, and for those of you who have been waiting for that one tell-all video, here it is. Now, if you want to know more in depth about each topic that I'm going to cover in this video, I already have a series that does that, and you can check that out. But if you need a little bit of a refresher, this is the video for you. Hey guys, it's Nufrar, and here are the 8 steps for financial independence. Now, this is something I've repeated a few times before, and I'm going to say it again. In order to achieve financial independence, you have to first understand financial literacy. For the 8 topics on the screen in front of you, we're going to cover what each one means and how you can implement this knowledge in your daily life to become financially independent. Let's start with a recap of what we already know about how to manage your expenses. Wait, what are expenses again? Expenses are all the costs that you incur in order to live. This includes bills for rent, water, food, clothes, transportation, etc. These are daily activities that cost you money, but long-term costs like buying a car or a house are also expenses. All of this comes under the term cost of living. And though you can't avoid most of these costs, what you can do is to track all of them. Any sort of spreadsheet will help you do this, and once you identify your unnecessary costs, you can pinpoint which areas you can cut down on. For example, a subscription that you don't really need. That said, don't cut out all of your quote unquote unnecessary costs. Of course, you're free to do so if you wish, but balance is healthy. So instead, consider this. If you're eating out, say 10 times a month, consider cutting that down to 5 or 6 times. Next is going to be income. You may already be earning one of these types of incomes as you watch this video, but have you utilized the other form of income? Let me tell you what I mean. Everyone needs an income in order to pay their expenses, and there are 2 types of incomes you can earn: active income and passive income. And the earlier you start earning both types of these incomes, the faster you can achieve financial independence. An active income is earned from going to a job every day and receiving a paycheck at the end of each month. Then you can take 20 to 25% of your active income and put it into investments like stocks and real estate in order to kickstart your passive income. Earning on these 2 fronts will not only help you pay your daily expenses, but also let you save money down the road for the more costlier expenses you might want to enjoy, like buying a car, going on vacation, or having a wedding. Unfortunately, no matter how much you earn or how you earn it, everyone has to pay taxes. There are 4 kinds of taxes: state tax, federal income tax, property tax, and sales tax. State tax and federal income tax are the same in principle. A percentage of your income has to be paid to the federal government, and if your state also requires state tax, a percentage of your income also has to be paid to the state government. The bigger your income, the higher the percentage of it will be subject to taxes. And property tax is simple. If you own a home, you have to pay taxes on it. The size and county your home is in determines how much tax you'll have to pay, since the rules differ from county to county and state to state. Finally, most states enforce something called a state tax on almost every item you buy. Unlike the others, sales tax isn't taken from your paycheck and is instead charged on every purchase of a good you can make. P.S. If you want to know how you can lower how much you pay towards taxes, you can check out my video on that. Now, in order to kickstart your passive income, you need to use your active income. To have money to invest, you need to have money saved. One way you can go about saving is the 50-30-20 rule. 50% of your active income goes towards your expenses, 30% towards your other needs or wants, and 20% towards your savings. But a better way to go about this wouldn't be to think of the 20% you put towards your savings as the remaining amount after paying your expenses. Instead, think of it like this: salary minus your savings should equal the number or amount you should limit your expenses within. Now we have the savings part figured out, invest your money little by little. You probably know the more common forms of investing, like stocks, but did you know that earning compound interest on your money is also a form of investing? While you can invest in the stock market, you can earn compound interest on your money by doing next to nothing. You can put your money into a savings account, a CD, which is a certificate of deposit, a retirement account, etc., and use this formula to calculate your savings. Debt. It keeps the world running. Understanding how to use debt to your advantage will significantly help you reach financial independency. It may be hard to put yourself into a position where you constantly owe money, but unfortunately, in today's world, avoiding loans is a privilege not many are afforded. So, let me help you understand what types of debt you should take on and what types you should avoid. Good debt includes loans for education and housing, both of which are essential to your financial, psychological, and social well being. Bad debt can be any type of debt you owe for things you don't need, like a fancy car or credit card debt. Now, credit cards are extremely important. For most, that's how everyday transactions and bills are paid. However, overspending on your credit card is financially a bad move, both for your present situation and for your future. It can drop your credit score, which shows banks that you're untrustworthy, and limit your capability to receive loans in the future at good interest rates. Now, in order to maintain a good interest score, use only about 30% of your credit card and make sure to pay it on time. That's one of the most helpful things you can do for yourself. Maintaining your credit well can help you take on more loans and grow your money, but make sure you don't start using credit as a clutch and fall into a debt trap. Remember, all of this is to make sure you can finance your own lifestyle with your own income. Now, imagine you've built up some savings and decided you're ready to take on a loan for the house you're about to buy. Just like how mortgage and monthly bills are important to take on to maintain your house, you also need to buy insurance. And this isn't just for a house. For example, if you want to drive, the law mandates you have insurance on your car. Insurance is a safety net, albeit an expensive one, that can protect your money and assets. In the event of an accident of any kind, maybe a natural disaster or a work injury, insurance can help you recover your losses and pay for the value of the item you pay insurance on. So, if you live in an area prone to hurricanes, you can take out a specific insurance plan to protect your house. So, if it does get caught in a hurricane, the payments you made to your insurance company can help pay out the money needed for damages and repairs. However, keep in mind that insurance companies will look for any reason not to pay, so make sure you take out the right plans for you and manage what happens to your money and assets in the most responsible way you can. Another way you can protect your money is to avoid falling prey to scams. However, that's easier said than done. Between the time of my previous video covering different types of scams and fraud and today's video, an increasingly frightening and realistic type of scam has already spread and conned thousands out of their money. How? Through artificial intelligence. Now, scammers can realistically mimic someone's voice, photo, or even a video of them. With such convincing media, it can be hard to differentiate reality from fabrication. To avoid losing your money to these kinds of scams, never give out your personal information over the phone, especially data relating to your finances or identity. Companies and banks never ask for this kind of information over the phone. And if you think a loved one is in danger, ask them something personal to verify their identity or hang up and call the person back to be sure it's them. Also, be mindful what you post on social media. Anything you post, photos, videos, and text, can be used by scammers to create more convincing scams. You can also get scammed when getting hired for jobs by fraudulent companies. They send you checks to be used for the job, claim a mix-up, and ask for some amount of the check back, only for the bank to later inform you that the check they sent you was fraudulent and you lost money. These are only a couple of the numerous ways people will try to scam you, and it's unfortunate that you have to be cautious of this, but that's the world it's come to. And finally, it's important to learn all of these so you can be prepared for the economy at any time. As you may know, or will come to know, the cost of living is getting higher and higher, and for many, it's increasingly difficult to sustain on their current wages that aren't growing at the same rate as the cost of living. To be prepared for recessions and downturns, it's absolutely crucial to save and invest. Having savings can be a safety net for you to fall back on during hard times. So, for times when you're in between jobs or have to handle big medical bills. On that note, investing can help you grow your hard earned money. So, while you're out there studying or working a job, your investments are also hard at work. Knowing when to expect a recession can also help you prepare for it. Historically, recessions happen every 6 to 8 years, during periods of high inflation, which lower spending, leading to layoffs, which leads to even lesser spending, and the cycle persists. One more thing to remember is not to place all of your eggs in the same basket. If you invest in stocks, spread your investments over a few different sectors so a loss to one isn't a complete loss to your entire investment. And with that, we've covered the 8 steps for financial independence. Keep in mind that this is just a summary, and for more detailed coverage on each of these topics, feel free to check out my series, What is Financial Literacy? That's it for today, so stay tuned for more, and this is Newfire signing out.